Last week, we started developing the topic of risk management, and I gave you a broad overview. I already announced that today I'll be dealing with one aspect of that, which is credit risk. That's the one we're going to spend a lot of time. We're going to spend 2 whole weeks on credit risk. Credit risk is still today one of the most active areas of risk management, and we're going to look at it from 2 perspectives. One is the risk management perspective per se, and also from the trading perspective. So there's going to be 2 topics in one. That's why it takes 2 weeks. The thing is that they are intertwined. I am not going to be able to say this is pricing, this is risk management. They come together. And a lot of these theories of credit risk, especially pricing, they are still underdeveloped because the market is not rich enough yet. Who knows if it will ever be. It is not like market risk. It's going to be quite different. We don't have the 33-cent gain in credit to use as a driving example. We were very lucky with market risk. One example served us very well throughout the entire part of that course. We don't have that in credit. What we have in credit is other examples that I'm going to be telling you that we can use as a replacement of the 33-cent gain. And I'm going to give them to you in a business context so that at the same time we start to gain some very clear perspective on the applications of this. Yes?
Is it the case that we don't have a 33-cent gain in credit risk because it can't exist, or because we just haven't found it yet?
Because as we will see today, the market is not complete.
I see.
When we looked at market risk, we saw the fundamental theorem of asset pricing, and then we saw that if I have a collection of instruments with prices, I can price everything. I have risk neutral measures, I have state price deflators, I can set up systems of equations, perhaps with infinitely many variables, and I can solve things. But for that, I need to be able to price everything by the market. And a lot of the things in credit are just not priced. Credit has to do with default. And as we will see here today, first of all, default events are rare. And when they happen only once, which means there's really a lack of history. And everything that we will be doing will be almost by analogy, which is the reason why mathematics is so relevant in this context, because it's much more difficult. And the concept of portfolio replication, for example, is very rare. The example I want to focus on is an example from 1983. Looks like a long time ago, but this is really the beginning of how a credit was created. And so this example will serve several purposes for us. It will give us a very good example to build upon and to create theories. It will also help us understand how this thing was born. Credit is very old as a concept. You know the origin of the word credit, where it comes from? Credit? No? Okay. I don't know if you know much Latin, but have you heard the word credo in Latin? Credere? No? It's belief. Okay? It comes from trust. That's what credit is all about. So a credit card is really a trust card. They trust you that you will pay. Credit is very old, but what we will be talking about today is very new. And this is perhaps this is considered to be one of the first examples of proper credit trading. This is not risk management. This is going to be trading, as you will see. So the context is 1983. I will tell you, we will have to know a few things about what happened in 1983. I will tell you as I develop this case. I want to spend a little bit of time on this case, perhaps not as much as I spent on the 33-cent game. After all, this is not going to be as ubiquitous as the 33-cent game, but almost. B.F. Goodrich is a company. Back then, they did almost exclusively tires for cars. Now they do other things. They are in the aerospace manufacturing area. B.F. Goodrich is a company that in the year we're talking about, they were mostly a tire company. You may have driven a car. Maybe you have been driven in a car with Goodrich tires. You probably know the brand Goodrich. They do military equipment. They do PVC. They're a PVC manufacturer. They do other things. But for what matters to us today, they're going to be a tire manufacturer. That's it. In 1983, that's essentially what they were. That's Goodrich. And then there's going to be another player in our business case discussion, which is Rabobank. It's a bank you probably have never heard of before. Have you heard of Rabobank? No. A Dutch bank is one of the large international financial conglomerates based in the Netherlands. Not very well known. They do very specialty financial products. It's very big, but it's going to be very relevant for us today, given what we're going to be discussing. So, B.F. Goodrich was a company in some difficulties. Later on today, we will learn what BBB minus means, but that was their credit rating. Not that I need that in any way for what I'm about to explain. But I do want you to know what happened in 1983. Have you heard that year before, 1983? You don't know what happened in 1983? No, okay. You know what happened in 2008? That was the financial crisis, yes? Okay, so let me tell you, as 2008 was unfolding, the discussion in 2008 is this going to be as bad as 1983? Okay, so there have been 3 big years in financial history. We saw that last week. 1929, the market crash and the Great Depression. 1983 and 2008. Today we'll talk about 1983. 1983, we had car sales down. This is going to come up later on in this course when we talk about 2008. We'll talk some more about 2008, but cars were just not being sold. Interest rates were at 11%, and the world was, especially North America, was in a very sustained recession. So what happens if you're in a recession? Are we in a recession right now? No. Were we in a recession in 2008?
Yes.
Yes. How did we come out of the recession in 2008?
Quantitative easing.
Quantitative easing. What does that mean? You have to know these things, and you should speak in class. Your mark depends on it, right? Quantitative easing. What is that? I cannot hear you.
The Fed injected liquidity into the market.
Right, and that meant it's another way of saying that you bring interest rates down, right? During COVID, did the governments inject liquidity into the markets too?
Yes.
Yes, okay. And that made what? That made interest rates very low, right? Okay, now interest rates are not so low anymore. Why?
To cool down the market.
Because of inflation. Okay? Because of inflation. We're not going to talk about inflation today. It's not relevant. But I want you to understand that if during 2008, interest rates had been at 11%, things would have been much, much more difficult than they were. 2008 was already worse than 1983. And we got out of that because rates were low. 1983 was not as bad as 2008, but look at interest rates, 11%. What are interest rates now? 8? What number did you get in your assignment number 1? You all did assignment number 1. Assignment number 1 is going to come up live today, okay? Very, very live. And you have to keep it very much in your mind. What numbers did you calculated interest rates for all possible terms? What numbers did you come up with? What? I cannot hear you. You have to speak up. I can still not hear you. 4. Yes, you came up with the number 4. You did not come up with the number 11. If you came up with the number 11, you would have made a mistake. Yeah? So what's the difference between 4 and 11? It's a very, very big difference. If you're buying cars, who buys cars? Who buys cars and trucks? Who buys things with tires?
I own a truck. I have bought, but I don't buy.
Well, the thing is that the most of those come from industrial activities. So companies buy that. So what happens if interest rates are at 11%? You don't spend. That's what happens. You do not spend. So if you do not spend, well, you have to buy certain things. You have to buy food, for example, right? So food is still going to be sold. How about cars? Do you hold on to that car 1 more year, 2 more years? Just to give you some context, this is important. I need you to understand this. Otherwise, the math that we do will be without context and not too useful for you. Just to give you some context, not in 1983, but in 2008, car sales numbers were down. They were down so much that the implied longevity of a car was 27 years. Do you know what that means? The implied longevity of a car was 27 years. It means if cars were sold at this rate, people will hold on to their car for 27 years. Okay, do you know anybody who drives a 27-year-old car? Well, I know some people in Cuba, they drive even older cars, but that's rare, yes? So during a period of recession, with interest rate at 11%, you don't sell cars. If you don't sell cars, you don't sell tires. And by the way, you can say, well, tires can still be put on existing cars. But if people don't buy cars, they're going to stretch the life of that tire. And if the tread is a little bit thin, who cares? I'll delay. So they were in financial difficulty, perhaps for a short period of time, perhaps not. No one knows. So that's P.F. Goodrich. Is this understood? Yeah? So this is the situation in 1983. Cars not being sold, and as it's going to be relevant for us, interest rates at 11% and a recession. I need you to understand these things. Don't just wait for the formula to find your comfort. You have to get comfortable with these things. You have to understand what we're talking about. Okay? Are you understanding this? And B.F. Goodrich, they were in financial difficulty and they were looking for fixed rate financing. Now, this is not a course in finance. If it was, we will spend a lot of time discussing why. But we're not. We just, oh, they want fixed rate financing. Fine, we'll take that for granted. I'm not going to get into that, okay? Let me move over to Rabobank. Rabobank was in a different part of the financial situation. Financially very strong. AAA rating, as good as it gets. Probably stronger than the government of Canada, okay? Very strong. They managed one of their businesses, just to give you an idea of why they were looking for what they were looking for, they managed the pension for Belgian dentists. When you manage a pension, you're looking for you're looking for variable rate yield. Why? I do want to spend, although this is not a course in finance, I do want to spend a bit of time on that. Why, if you manage a pension, you want variable rate?
If it goes up, you want. If the rate goes one way or the other, you might want to go that way.
No.
Oh.
No. What do pensions want? You have a pension. You all have a pension, I assume, yes? That's for your retirement, yes? Are you thinking of retirement? Oh, you're already thinking of retirement, but it's not coming anytime soon to you, is it? But if someone is managing your pension, all they think about is your retirement. They don't think about your next job. You think about that. They think about your retirement. And what's the risk when you retire? Is that your contributions now become worthless because of inflation. So if rates are high, you need to have higher returns. But if rates are low, that's okay. You can have lower returns, yes? So you're looking for variable rate exposure. That's the nature of a pension, right? Okay, so very different appetite for financing, BF Goodrich and Rabobank. Now, let's look at the situation with, yes, sir.
Can you explain variable rate yield again? Does that mean that the return of the asset fluctuates with the return with the interest rates in the market?
Yes. So yes. So let me express this differently. Okay. Thank you for asking. If you're running a pension, pensions are typically benchmarked to inflation. Inflation is not the same as LIBOR or Fed funds or something like that. Inflation goes up and down, but they are related. So if you manage a pension, you're benchmarked to inflation, which means that if inflation is high, your returns should be higher. Otherwise, your pensioners, by the time you retire, your contribution is now worthless, right? Especially for long-term investment. For me, less relevant, but for you, you will lose a lot of value. That's why pensions, they're looking for investments for their assets, which are variable. We're not going to get, again, not a course in finance. I'm not going to get into exactly what you mean, what type of variability. It's just that so we're not surprised that they're looking for variable rate financing. Okay, you could see, I'm not going to discuss this again, but that Goodrich, they want fixed rate. Why? Because they need to budget for next year, right? Or in the year after. So if you're a company, you like certainty. Say, well, you know what? Don't give me that uncertainty of variable rates. That's why they want fixed rate. I didn't want to get into that, and I don't want to. If that satisfies you, great. But I want you to understand they have different appetite for financing. Okay. Sorry, another thing with Rabobank, they're not looking for financing. They have more than enough money. They're looking for exposure to variable rates, which for us is the same. Whether you're lending or borrowing, it doesn't matter. They're looking for variable rate. Okay? All right. Now, this is the situation with interest rates. You have it there in that table in green. This is very interesting. Let's look at that. Let's look at that. Look at Goodrich. If they go into the fixed rate market, you go out there and say, I want a fixed rate loan. They were quoted 12.8%. But if they were looking for a floating rate loan, or financing or bond, I'm not going to get into that again. This is not a course in finance. They would get Fed rate plus 50 basis points. I'm talking about Fed because LIBOR did not exist. LIBOR was a few years away. Otherwise, I would have said LIBOR, but LIBOR didn't exist. LIBOR was created, I think, in 1986 or something like that. So the equivalent of that was the Fed funds. This is the rate at which the Fed would lend. Fed funds. So that's the variable rate. So and the Fed rate was 11%. 11%. Okay? So they wanted that, but this is what was cheap, right? And Rabobank didn't care. They have such good credit rating that it didn't matter. I'm not going to get into why that's the case. I'm just going to accept it. Again, this is not a course in finance. It's a course in quantitative finance. So I'm going to just accept that, right? So I think, and that's why the interesting part of this example is in Goodrich, not on the Rabobank side. So if you're Goodrich, what happens there? I hate that sound. If you're Goodrich, what happens there? It happens to Goodrich what happens to me when I go shopping. The thing I want is the expensive one. And what is cheap is not exactly what I want. Does it happen to you too? It happens to all of us, right? In finance, there is something we can do about that. And this was one of the big discoveries of the year 1983. So what happens is this. With this situation in mind, they both shared a consultant, the same consultant. I think it was Salomon Brothers. I think it was Salomon Brothers. And Salomon Brothers knew about the situation of both of these. This is a financial intermediary. You're going to learn today what financial intermediaries do. This is a job that some of you may end up doing. So what they say, why don't you do this? And now this is the structure that was created. I need you to understand it. I need you to understand it. What they said is, Goodrich, this is what you do. Go out there and get what's cheap for you. It's not what you want, but get what's cheap for you, which is get a floating rate loan at Fed funds plus 50 basis points. At least it's cheap. So, oh, but now I cannot do my budgeting. This is very risky. Just do it for a minute, okay? Just do it for a minute. You following me? Yeah. And then they will say, Rabobank, you go out there and you get your fixed rate exposure. I'm not going to get into what instruments they actually bought. It's not relevant. And Rabobank will say, but that's not what I want. I said, just do it, okay? Because the next thing you're going to do is you're going to create a trust. The trust is just like a fund. It's like an intermediary. The Morgan Guarantee Trust. That was the name of it. And what this is going to do is the following. This is what's interesting. It's going to enter into a swap agreement with Goodrich. We've talked about swaps in the past, but now I'm going to explain to you what it is. BF Goodrich and the trust are going to exchange payments on the annual, semi-annual. Let's ignore that for a minute. They're going to exchange payments as follows. As rates fluctuate, they're going to exchange payments as follows. BF Goodrich is liable to pay the trust 11% annual. That is $5.5 million. I forgot to mention here the loan was for $50 million. With an M, by the way. If it was 2008, it would have been with a B. Billion. But it was M's, millions. Yes? So they will pay $5.5 million per year to the trust, and they will receive Fed funds minus some number that we'll think about later. They're going to exchange payments. So if Fed was at 11% as it was, so at the beginning, and if that spread X is 0, then there will be no payments made or received. Understand? If X is 0, at the beginning of that swap, there will be no payments made between one or the other. But what happens if rates go high? What happens? If Fed rates go high, what happens? The trust will pay money to Goodrich. And if rates go low, Goodrich will pay the trust. Okay, that's called a swap. No one knows where rates are going to go, but every 6 months, there's going to be some calculation there. Money will flow. And every year, there will be additional money or some other money going the other way. Yes?
Sorry, so every year BF Goodrich gives the Morgan Guarantee Trust $5.5 million.
No.
And
no, gives the net. This is very important.
Sure.
Okay, the net.
So there's zero cash flow because like instantaneously.
Yes.
11% and then they give them back.
Exactly. So you settle this. Ignore the semi-annual versus annual. Let's ignore that. It's not relevant for what we're discussing today. Again, this is not a course in finance. Ignore that. So what you would do is every so often say, okay, it's time to make a payment. How much do I owe you? How much do you owe me? Oh, this time I give you $1. This time you give me $1. The idea is that this is going to be much, much lower than $5 million. At inception, this is zero. But as rates go up or down, the idea that this will be a correction to what? This is a correction to what? It's a correction to that, because look at Goodrich. What does Goodrich get at the end of this left side of the screen? What does Goodrich get? Goodrich gets fixed rate financing, is what they wanted. Yes? It's pretty good. Let's look at the other side of the equation. Let's look at Rabobank. Rabobank is going to do the opposite. It's going to receive 11% fixed annually, and is going to pay Fed minus a different number, Y, percent semi-annually. What's the result for Rabobank? They get what they wanted, floating rate exposure. So except for the numbers X and the numbers Y, except for that, what we've managed to do is very interesting. Next time we go shopping, you come with me. One of you, who goes shopping here very often? Who likes to shop? You like to, you and I will go shopping together, right? So this is very good for me, but you know what? It's very expensive, but it's very cheap for you. And then what's cheap for you? So we buy it and then we swap it. That's what they did.
But in that example, there's no trust. It's just you and me.
No, hold on. I'm coming to that, okay? Yeah, so in our example, yes, it's just you and me, all right? Now, this is done through a financial intermediary, and this is very important. It's very important for several reasons. First, Rabobank did not know about Goodrich, and very likely they never knew about each other. They just knew that someone called Morgan Guaranty Trust shows up and said, I have a deal for you. I said, oh my God, that's a very good deal for me. How come you know that's what I want? It wasn't like that, but you can imagine. Say, don't worry, you like it? Yes, okay, fine, I'll do it. And then they did the same thing to Rabobank, right? Now, this is the important part I want you to understand. There are two very important things I want you to understand. One is the business aspect of this. Why would Goodrich do this? That's the easy question. Why would Goodrich do this?
Because it gives them the 11% fixed annually.
It gives them what they want, and as long as that number X is less than what? 1.3. As long as that X is less than 1.3, they save money. You see that? You see that? Good. Why does Rabobank do this? They get what they want, and as long as Y is positive, they save money. Do you see that? The interesting question is, why does Morgan do this?
Right.
Why does Morgan do this? That you tell me.
I mean, they got to be making money somehow, right?
Yeah, exactly. You tell me how. You tell me how. How is Morgan making money? I cannot hear. You have to speak up very slowly and very loud.
By creating different X and Y.
Yes, exactly. And what does Morgan want?
Commission.
No. Actually, there's no commission here.
Okay.
No, there's no commission. The commission is already built into this. What I'm asking is X and Y are here. What is bigger, X or Y?
So they're giving away Fed minus X, and they're receiving Fed minus Y.
Exactly.
X has to be greater than Y.
X has to be greater than Y. As long as X is greater than Y, Morgan makes money. Yes? So this is very interesting, because if I set this up with a, we already saw that as long as X is less than 1.3, 130 basis points, Goodrich is happy. As long as Y is positive, Rabobank is happy. And as long as X is bigger than Y, Morgan is happy. Is there a solution to that?
Yeah. Just take Y to be half X.
There's many solutions to that. Many solutions to that, right? Now, this is how a deal happens. I want you to understand this deal very well. You see that? Let's say you are the consultant that is advising both of these on this transaction. You're the consultant maybe to Morgan, maybe to Rabobank, maybe to everybody. You are the mastermind. You're the one who sets up this trust. You know what a trust is? What is a trust? What is a trust? Trust is like a fund. So very likely this was a company set up by someone, said, you know what, I have some money, I'm not gonna get into how much money, so I'm gonna create a trust, and this trust will become the counterparty to both of these transactions. And you're gonna collect a fee for that, and the fee is not a commission, the fee is the difference between X and Y. Yes? I told you that on reading week, we stopped working for free. Now we're working for money. And everybody's making money. Goodrich is making money, Rabobank is making money, and if Morgan is smart, they will make money too. We didn't get into that yet. The first thing I want you to notice is that this seems to go against the first half of this course, where we had the fundamental theorem of asset pricing, everybody works for free, there are no arbitrage opportunities. We have arbitrage opportunities here, right? Is this an arbitrage opportunity? Is this an arbitrage opportunity? Not exactly. It's not exactly, because no one is making money for sure. You can say, oh, I'm saving money, good for you. Rabobank says, oh, I'm saving money too. Oh, well, good for you. How about Morgan? Is Morgan making money for sure? Is Morgan making money for sure? This is the answer. If Goodrich and Rabobank always do what they are supposed to do, yes, they make money for sure. So that would be an arbitrage. But how do we know that Goodrich in particular will always honor its obligations? We don't. Well, even Rabobank, so well, Rabobank is great. How do I know Rabobank will, why? How do I know that they were not financing Osama bin Laden and then they get taken to jail and they go bankrupt like Silicon Valley Bank in 24 hours? How do we know that? We don't know. There's always the possibility. This is what has happened after reading week. The world for us is becoming real. And a lot of those nice theories, now they're going to be a good guide, but we're going to be dealing with real situations. So I want you to understand this. Morgan is making money, but it's not for free, because they are taking a risk. It's a risk we have not seen before. It's credit risk, because if everybody pays, yes, they make money for free. But the minute someone, Goodrich or Rabobank, does not do their obligations, they will lose money. You see what I mean? Yes.
So the not for free is the price of risk.
Yes, we're getting to that, exactly. And this is part of the reason why I don't have a 33-cent game, because this market is very hard to make complete. In the first part of this course, we made markets complete by throwing another option with some price, and then the whole thing is completed. Now, although this could happen, and the markets have becoming more and more mature and complete, and now we have something called credit default swaps, which, for example, will allow this thing to be complete, and then you could have the absence of arbitrage situation and a complete market, an efficient market hypothesis, like in the first part of this course, it still is very limited. It still is very limited, okay? A credit default swap would be the equivalent of an insurance company policy. Imagine that Morgan could buy insurance against Goodrich and against Rabobank defaulting. Imagine that. Then you know, assuming the insurance company does not go bankrupt, then you know how to price X and Y. But absent that, if you don't have an insurance policy against Goodrich or Rabobank going bankrupt, then You don't know that you're going to make money for free. So you have to make money with a certain level of confidence. X and Y will determine that. You understand what we're saying? You understand this? This is called structured credit. You understand the transaction? Do you understand the transaction? Yes?
So this type of thing had never existed before this particular example? Like,
No.
Mortgage Guarantee Trust invented this?
No, they didn't invent it. This one was invented by, I think, Salomon Brothers. And that was just the name they gave to the trust they created. Who knows? Maybe JP Morgan put some money into that. I don't know that. But these things, no, these things did not exist before that time. Swaps, actually, the concept of a swap, the swaps were created at this time, and they were created at this time because the market conditions were very unique. We discussed that, I think, last week when I showed you the evolution of markets since 1929, and I showed you about the post-oil crisis volatility in the market. This was created by the oil crisis, by the way. Just like 2008 was created by the subprime and the structured credit blow-up in the 2000s, this was created by the oil crisis and the market volatility it gave rise to, and the fact that interest rates were going crazy and inflation was very high because the price of oil was extraordinarily high, and so on and so forth. The inflation we're dealing with now in the 70s was the price of oil and the scarcity of oil. Yes?
So does X and Y depend on the probability of default?
Yes, we're coming to that. Yes, exactly. Very good point, very good point. Do you see what's behind this? You understand the example? We are there. Everybody, now can you see what's behind this? How interesting this could be? Because now, to make this happen, I mean, Morgan is not sold. Say, wait a minute, this looks interesting to me. If you're Morgan, say, this looks interesting to me. As long as X is bigger than Y, I will make money, but am I making enough money? What risk am I really taking? And is the risk that I'm taking something which compares well to my income? My income is X minus Y percent on 50 million. That's what we need to determine. That's the question. How much is that risk worth? Today, I hope to answer not that question, but questions which are similar to that, a little bit easier. That is my objective for today. And then next week, I will give you a more commercial approach to that, so you see how these things are actually done in industry. Today's going to be a little bit of math. Next week will be a lot of commercial solutions. But this is different from everything we have done before. There is risk there, risk that we don't know how to hedge. Now we need to price it somehow and then decide if it's a good deal. But this is how the world works. Who has a mortgage here? I have a mortgage. So when the bank lends me money, they are taking risk, yes? How do they compensate themselves for the risk they take? Is the interest that I pay them. I don't pay them a commission. I pay them an interest rate which is higher than their cost of money. Some of you may have a student loan. How does a student loan work? They're lending you money. How do they know you're going to pay them back? They don't. Who's compensating them for that risk? Someone is. That's what we're talking about today. Okay? This is not about the stock going up or stock going down. That we already saw how you can hedge that. That part is done. We're done with that. Now it's something different. What if you don't pay? Yes? Okay. That's what we're dealing with. This is my first example. Any questions? Yes.
is it things like the both company buy the insurance from the trust, like to for the i- inflation rates or for the fast rates?
Okay, so you said something. You said you're asking me if these companies buy insurance from the trust. No, that's not what they're doing. These companies, what they do is they have a swap agreement with the trust so that if interest rates go up, some pays the trust and some receives money from the trust. And if rates go down, the opposite happens. You can think of that as insurance, but it's not a good analogy because insurance is you get money if something happens, and if nothing happens, you just pay the premium. An option, for example, would be closer to being insurance than this. This is more like a futures contract, right? It's like the price of rice is high, then I pay more. If it's low, I pay less.
I just want to ask if there's for mortgage kind of like reduced counterparty risk, it's kind of like obligation to make sure the exchange, the swap gonna like process successful, and then for the mortgage gonna buy the CDS. Kind of
Okay, okay, very, yeah, okay, yeah. So let me answer your second question first.
Okay.
There were no CDSs in 1983. Okay, so I mentioned CDS, that's a credit default swap. They didn't exist in 1983. And that's why I like this example, because there was no additional protection available. And I want to look at it from this perspective because that is how we're going to get into this topic of credit, right? Otherwise, if this was a complete market, then I would do, if a CDS was available, then maybe I can hedge this with a CDS and then you can actually make money for free. Then there's a real arbitrage. That's why I mentioned this example. And I forgot your first question now.
I just want to ask, like, for the mortgage, it's kind of like an obligation to reduce the counterparty risk, like make sure.
Okay, yeah, no. So that's a very good question, but let me answer that question differently. Let me tell you the real reason Morgan got into this, which is a very interesting reason. And this is something that will be very clear to those of you that have perhaps an economics degree. So there's a little bit of finance that I do want to put on the table today, just a little bit. And this is the reason why it was believed by the creators of this structure that the default risk, the credit risk, was actually lower than it looks. And it has to do with this. So this is the thinking now. I'm going to give you an argument, which is the real reason why this thing actually existed. Is the reason why there was a way to make this thing happen. Let's do a ballpark calculation. We know that as long as X is less than 1.3, 130 basis points, then Goodrich is happy, right? So if that's the case, you would say, well, 1.3 divided by 3 is about what, 40 basis points, right? So if X is 40 basis points and if X is 80 basis points and Y is 40 basis points, then Rabobank is happy, they're making 40 basis points. 40 basis points is pretty good. It's pretty good. And 80 basis points is still 40 basis points better than the market rate. It's pretty good. And then Morgan makes 30 basis points, 40 basis points for free, taking that credit risk into account. You see what I'm saying? Right? So if 40 basis points is what makes this deal work, now I have the question, is 40 basis points good enough for Morgan to get into this? And I would say if it was a different deal, maybe not. But let's look at this deal in some more detail with a financial mind. Let's look at this with a financial mind. This is what Morgan is thinking. What's bad for Morgan? No issues on Rabobank. They will always pay. That was not a consideration, right? Sure, something catastrophic could happen to them in 24 hours, and what can you do? You cannot prepare for those events. So Rabobank was not the issue. The issue was Goodrich. That was the source of risk. So what is bad? What is bad for Morgan? That rates go up or that rates go down? Think about that. If you're Morgan and you're worried, what is your worry? That rates go up or rates go down?
Rates go up.
You worry that rates go up. Okay, if rates go up, what's going to happen?
Okay.
If rates go up and Goodrich goes bankrupt, what happens? You're going to pay them money. Big deal. You pay them money because you're going to get the money from Rabobank, right? That is not your concern. Your concern is rates go down. Because if rates go down, what happens? Goodrich is going to pay you money. And that's when you worry that they don't pay. You don't worry that someone doesn't pay when you have to pay them. Right? You worry when someone has to pay you and they don't. All right, so for that to happen, rates have to go down. You see that? But the thinking is, if rates go down, what will happen to Goodrich? They will sell tires. They will be back in business. Yes? So it is said that this was the reason that Morgan got into this deal. I don't know this for a fact, I wasn't there. But if you look at that, you would probably see that yourselves, yes?
But should that the Morgan Trust considers how much the both company gets from the trust? Like, if the left side borrow like 55 million and the right side just borrow like 10 million.
No, the same amount. Sorry, the same amount. 50.
Oh.
50. No, sorry. Okay, I forgot to. It's 50 million on both sides. No. The 50 million. I didn't say that. It's 50 million on both sides. Exactly the same amount. Okay. Goodrich needed 50 million. They had a deficit of 33 million, I think, that year. So they wanted 50. And Rabobank was probably there just to take whatever was given to them. They probably wanted this 50 and even more if more was available. But I think this deal was for 50 million. Yes.
Why should it be the same amount? I think if there's a little bit different, if there's a change in X and Y, it will still be profitable for the trust.
No, if it's a different amount, then suddenly we're talking about something different. Now we're talking about Morgan taking market risk and not only credit risk. Right? So this deal was for the same amount. If it's a different amount, we know how to deal with the market risk aspect of this. That falls under part 1 of this course, right? But I'm not interested in that. That's why I like this example. Because this is strictly part 2. No market risk, only credit risk. Is this well understood? This is the equivalent of our 33-cent game. The difference is that this is real. It actually happened. Yes? Can I move on? Okay. I'm going to move on to my next example. My next example is much more contemporary, and it has to do with something that I am not going to do in this course. But many of you will be doing in practice, and the courses which are relevant for this are perhaps given by the computer science department or the engineering department, but they don't know they are relevant. So I want you to know. I'm going to just tell you the finance aspects of this, and then all of the data science and machine learning aspects of this you already have seen. I don't have to talk about that. All right? This is a very modern deal, Scotiabank and Cencosud deal. This is Cencosud is before I give you this example, perhaps I should tell you something else. I don't know if we talked about this. Loblaws. You know Loblaws? I don't know if we've talked about Loblaws. Have we talked about Loblaws in this course? Forgot Loblaws. Okay, so you know Loblaw. You know Loblaw and Loblaws. Loblaws is the supermarket. Loblaw is the company. Yes. Okay, great. you know they have this. You know they have a bank. You know Loblaws has a bank.
President's choice.
President's Choice Financial. They're a bank and other things. They give you credit cards, they give you stuff, yes? Okay, there's another thing that Loblaws has. Loblaw, there's another thing that Loblaw has. You know what it is? Shoppers Drug Mart. Interesting. Supermarket, the biggest pharmacy in Canada, and a bank. How do these things go together? Now you need to think like business people, not mathematicians. Supermarket, pharmacy, bank.
They're all things people need.
Well, yeah, it's what people need, but what is the, I mean, you could say, well, I'm going to make cars too, or I'm going to, you know,
Loyalty program between their business.
Loyalty program ensures what?
Yeah, just like you buy something from the Loblaws and you can get some discount with your credit card or something like that.
Okay, good. Okay, so that's your side of the deal. You may get a discount. What is their side of the deal? You're in the loyalty program of Loblaws? Yes, I am. Yeah. What's their side? What do they get? They give you a discount. What do they get? What?
Like more cardholders, more clients.
They get the same customers using all three.
They get data from you. We're going to learn the value of the data now. So I'm not going to talk about Loblaws. By the way, some people from this course are working in their data center. Okay, you can probably find them on LinkedIn. Yes, they have a very large data center. They are building with people like you in Brampton. Yes, hundreds of data scientists. I'm not talking about Loblaws. I'm going to talk about Scotiabank and Cencosud, and you will understand why. This is modern day credit. Very different, but very interesting for you. This deal is from 2014. What happens is this. Scotiabank entered into a deal with Cencosud. Cencosud is a conglomerate very much like Loblaw, except they didn't have a bank. They had supermarkets, Jumbo, Metro, and some others. There's are supermarkets in Chile, by the way. They're in Chile, okay? They're supermarkets in Chile, and they had a loyalty program. Yes, they did. You will see how interesting this loyalty program is. So what was the deal here? I have some press releases from this, and I'm trying to be careful to tell you only things which are publicly known, not to know things that I know, but I cannot say. What is the deal here? The deal is this. It was very interesting. What Scotiabank was going to do was as follows. Was going to create in 2014 a micro loan business in Chile. It works as follows. First, the supermarket has a loyalty program. They know the customers. They know what they buy, when, in which store. They have all of that information. Yes? Loblaws has that about me and you, if you have a loyalty program. They have that. Great. Okay, perfect. So if you're a registered customer of the supermarket, when you go to the checkout, you can say, by the way, can I have a loan up to $300 on the spot? Picture that? Yeah?
Kind of like cash back, but you're not paying for it, you're just getting a loan.
You're getting a loan. Okay, you're getting a loan. The term and all that is not relevant. But up to $300. If you ask for a loan, this is what happens. And I'm not going to give you the full details because I don't know the full details. I don't know who does. Well, I mean, of course, I know people at Scotiabank know, but what you do is at that point, you have to share with the bank the customer profile. Actually, you probably have to share the whole database. You'll see how interesting this is. Yes? Because now the bank gets all of that. That's all of the information in the loyalty program. And within 5 seconds, the bank has 5 seconds to decide if you give that loan or not. 5 seconds. If the answer is yes, you say, here's your $300 or $250 or whatever you're asking for. The answer is no, you don't. This is modern day credit. What's the difference between Goodrich and this? You can say the amount, 50 million versus $300. Sure, the amount. But in what concerns you, in terms of your education, what's the difference here, sir?
I was going to say there's no middleman, but maybe, are you the middleman?
No, there's a middleman. The middleman here is the supermarket. What's the difference here? The difference here, yes?
It's to a group of people, whereas like to a specific one, like a company.
So the difference is, in the previous example, we discussed X, Y, if X is bigger than Y, it's okay, and then you will understand how that financial transaction makes sense from a risk perspective, right? And it's all predicated on Goodrich's ability to pay back. Now, for Goodrich not to pay, they have to go into bankruptcy, right? Which is something which is rare, but if it happens, like, that's it. Here, for a customer not to pay, what do they? Let's say they lie, right? You only have access to the customer profile. Maybe they don't even live in the address that they have registered there, right? Maybe they say they are a doctor earning $200,000 a year in Chile. That'll be a lot of money. And maybe they don't, right? Goodrich is a known quantity, but here the customer is a known quantity? Depends on your data. Let's say, I'm going to use a Toronto a version of that. Let's say in my customer profile, it says I make $500,000 a year, I live in Rosedale, and I've been living in my address for 18 years, and so on and so forth. Let's say that. That's great. Then I'll get a $300 loan, no problem, right? But imagine I've never shopped in any of the supermarkets in the area, right? Imagine the stuff I buy does not agree with my income. Can you imagine that? Your decision variables are completely different. And they are driven by data. It's not structured like in the case of Goodrich. Goodrich is a publicly traded company. They publish financials every quarter. They're audited every year, right? Someone lies in Goodrich with the money, they go to jail, right? You lie in your customer application, what happens to you? They can't even find you, maybe, right? You understand? This is driven by data. So the success of this business is predicated on something completely different. And that is, give the loan to the right customer. So the amount of finance here is very insignificant. What's big here is your ability to do data analysis and machine learning and all of that, and understand customer profiles. And you understand what I'm saying? This really is a different course. It's not APM466. This is closer to your machine learning course. The finance is very small, but the business is very big. That's why I don't talk about this in this course, because many of you, you've already seen this. You just did not know. You see what I'm talking about? Yes?
Why would Scotiabank do this? Like, what did they get out of it?
That's the next slide. I want you to understand this. This is very interesting, okay? The first thing is, Scotiabank, as you know, is a very big bank in 4 countries in Latin America, in Mexico, in Peru, Chile, and Colombia. And in the early times, when you get into this, this has certain advantages. For example, this is a way for Scotiabank to get into, to do business there without branches. right? Imagine if you're a bank and you go to a new country, typically you have to buy a bank. Actually, they did that later. They actually bought a bank. But that was a few years later. That was 5 years later, I think. For 5 years, you get to do business there without branches, without staff. They don't have to hire you to do anything, right? They have the supermarket and the cashier is actually working off balance sheet for the bank, and also regulatory advantages. So this is a very simple way for a bank to get into a new country. For example, in Canada, well, that's if you're going to do that in Canada, that's what Loblaw is doing. They went the other way around. I'm the supermarket, then I create my bank. Maybe they could have done a deal like that with BMO, and then Bank of Montreal would be their bank. But when you go to a new country, then a deal like this could happen. That, again, belongs to the world of finance. That's why people in finance, MBAs, this is what they do. They say, oh, you do that and you save yourself $25 million by doing this. Oh, great, let's do it. Is that clear? Now, there are very interesting aspects here, and this is the only thing I want to talk about this, which is that is the value of data, which is going to be absent in this course, because it becomes a different course if I do that. So I'm just going to spend a slide on this, try to make connections with things you've learned elsewhere. This is a very common thing today between companies, which is the cross-referencing of data that comes from different business lines. In the case of Loblaw, they have your shopping in the supermarket data, and they may have some of your health data if you go to the pharmacy also, right? And then they have a bank that maybe give you a mortgage. And maybe they know if you're sick. I don't know. It's a different way of getting into the financial sector. And there's a lot of that now. There's a lot of transversality when it comes to the use of data. Back to the supermarket case, you have a very interesting relationship between commercial lending and retail lending. And this is something that now we can do. Why? Because we have data. And again, you've taken these courses in other. And the data that becomes relevant is data which is non-numerical data sometimes. Is shopping patterns, family relationships. You've seen graph theory. A lot of that data is not like a time series. No. A time series is important, but it's not the only data available to you. The data which is relevant is other things. Metadata, right? And you have a need to extract data from different sources so that you can enhance the different business lines. This is what Amazon does. Actually, most companies do that now, right? That's why suddenly I get out of my course, and then it's a course that you've already taken. And you can provide enhanced risk-based systems. So everything I'm talking about here has a way of being used in this context. And now this transition goes from a risk-based to a rules-based. That's where machine learning comes in, because that's what machine learning is about. Okay, and that's it. That's all I wanted to say. So that you are aware that this part of my course connects with courses you've already taken. And I'm not going to pursue that anymore. Clear? All right, great. So then what I'm going to do is we're going to take a break now, 10-minute break. Then we come back, and when we come back, we'll start with credit pricing and all the stuff which is what we need to deal with math and these topics. So 10 minutes. I spent the first half of today trying to give you a sense for what credit is, how it works, and what might be involved in that. I'm now going to go into the mathematical aspects of what it is that we need to know so we can start to build the theory of credit. I'm going to be dealing with essentially 4 things. Cash flow valuation, which we already saw the first day of classes. I'm going to revisit that today, now. But I'm going to be doing that in the context of default and default probabilities. And this will eventually become a discussion on the credit process. Cheers. Cash flow valuation. We saw this the first day of classes. I'm going to do it all over again, but very quickly this time. If I have a series of cash flows denoted by the letter PI here, end payments denoted by the letter M, and interest rates given by the letter R, the value of my cash flows is given by that expression. We've seen that many times. I don't have to remind you that we're doing instantaneously compounded rates, and I'm typically going to use annual interest rates for my calculation. That's what we saw. And this was on one assumption, which is now going to be removed. This was on the assumption that each payment will happen for sure. Now we are removing that assumption. So if we remove the assumption that every payment will happen for sure, what would this look like? This is what it might look like. I have here, I'm going to attach a probability that each payment happens, what's called the probability of solvency. And then I would just rewrite my expression like that. Right? Okay, now, this might have been okay in January, but now we are in March. We've learned a few things. Is there something here that makes you feel uneasy when I wrote this down? Are you easily convinced that this would work? I'm not going to tell you. I'm just going to ask if you feel uneasy by something that just happened here. You look at this expression and you'll think it's okay. Yes? Multiply each payment, discounted to today's value, and then I multiply by the probability that payment will happen. What's wrong with that? Anybody knows what's wrong with that?
Should there be another term as a default?
Default?
It's like an insurance policy. If you default, you get that.
Oh, no. I'm not going to make it more complicated. I can make it more complicated, but no, I don't want to. Just something very, very simple, just to price the cash flows.
It seems like you're assuming events are mutually exclusive or something.
No. Just in that the probability that the payment will happen. Okay, I'm going to leave it there. I'm not going to give you the answer. The answer is coming, okay? But there's something that should have made you uneasy about this. I'm taking my payments, multiply by the probability that something happens. What's wrong with that?
Is there like an issue with dependence?
No, it's coming. Don't worry, it's coming. I'll continue, it's coming. Now, if we look at this expression, which by the way will be correct, okay? The fact that it was an uneasiness factor does not mean that the formula is wrong. It's correct, but there's something that I should have said. I'll say it later. First, I want to look at it and I want to see the implications of it. The first implication is that if I have a case, for example, of a loan where the value of the loan is known ahead of time, is where I'm borrowing, okay? Then if the probability that the payment event will be lower, will have to be compensated with what? With higher payments, right? That's why if you have poor credit, you typically have to pay more for your loans, yes? And at the same time, if the payments are fixed, in the case of a bond, then as the value of the probability of payment decreases, then the value will decrease too. That's why bonds issued by credit sensitive or credit challenged companies are cheaper. These are basic symmetry considerations for this, yes? Okay? Great. Now, this is the thing that made me uneasy, maybe should have made you uneasy. We've already learned how dangerous it is to price financial transactions with probabilities. That was my 33-cent game. It was not 50 cents. That was not the 50-cent game. It was the 33-cent game. And why was that? Remember that? Someone, I forgot who, was willing to play the 33-cent game and pay 49 cents. Why? Because you did not know about risk neutral probabilities back then. But now you do. Now you do. So you should have said that there was something missing in my expression, which is that the probability of payment should have been risk neutral. That should have been the uneasiness factor, okay? There's good news though, which is that in credit, it's almost impossible to work with any other probability which is not risk neutral. Why is that? Why is that? What's my probability of paying back a loan? What was the probability of Goodrich paying back that loan? How can you calculate that probability? Can you look at how often I have defaulted, for example? No. Can you look at how often Goodrich has defaulted? No. In fact, companies only default once. Right? When a company defaults, when they go on bankrupt, they don't recover. Defaults are forever. You may have heard of a company, General Motors, for example, they went bankrupt in 2008 and then they recovered, or Hertz, for example. What recovers is a different company, it's not the same. No one will accept the history of a default company as even related to the new company. The name is the same, but the company is different. So the problem with credit is that there is no history of defaults. Everything you do has to be forward-looking, and that is a big difference with market. You can say, I've observed this stock price for 5 years and I conclude whatever you want. In credit, I've seen this person pay forever. Does it mean they're going to continue to pay forever? No. Right? A lot of these events are. So when you will see, and we'll see that today here, that when we use probabilities of payment, they will almost always be risk neutral because they will be given by the market. They will be given by the market. Okay? Okay, so defaults occur only once. Counterparties do not default. Okay? When? Yes?
So basically, if a default occurs, the payment cease. If the payments are priced on the probability of, like, if the value is priced on a payment occurring, right? So, going by that logic, if a default occurs once, that means all payments will cease, right?
Yes, that's right. When a default occurs, then all remaining, when you're default forever. That's it. You don't, okay? When you go bankrupt, you don't, that's it, you're done.
Yes, so my problem was then that that probability term is not about each payment, right? That's just one single probability which tells you.
No. If you go to the previous slide, you will see that each payment has a probability of happening. Q sub I. I did not say that the Q sub i's are the same, they're different, they're related, unrelated. I didn't get into that. I just said, if this is the probability of solvency, or this is the probability of payment, that is the price. I did not say that the probability of, that there's a relationship between a Q sub I and Q sub I plus 1. I will do that later. But so far I haven't said anything. It was a very general formula. Okay? Today, we will be developing relationships between those probabilities. We will do that. But so far I haven't done anything. What I wrote there was very, very general, and it's correct as long as the probability is risk neutral. Okay? What does risk neutral mean? Don't worry, we will see that in the minutes to come. But that was the one thing I wanted to mention here. Okay? All right. I'm going to start my quantification of credit with the concept of the credit spread. And for that, I'm going to start with the hazard rate. The hazard rate is going to be that probability of solvency that I mentioned earlier. And what I'm going to do is I'm going to look at that probability of solvency, and I'm going to take the logarithm of that. It's a number which is negative. I make it positive by adding a minus sign to it, and I divide by the time at which I'm calculating the solvency. That's my hazard rate. It's just a definition. As mathematicians, this definition is perfectly fine, because as long as Q is a number between bigger than 0, this number exists. And if the number is less than 1, the number is positive. Big deal. Right? This is a definition. Why is this definition of any use? That's coming later. But this definition exists. Now, why is this of any use? It has the interesting use that if I rewrite my cash flow valuation formula using the hazard rate and not the probability of solvency, my cash flow valuation formula takes this shape. Something very interesting just happened. What is it? I have the same cash flow valuation formula as in day 1 of this course, when every payment was going to happen for sure. The only difference is that the rate has changed. The rate has increased. So could it be that I can now redo everything, just simply taking into account that the rate might be different for different counterparties? Wouldn't that be the case? And the answer is yes, to some extent. The answer is yes, to some extent. There was a question at the beginning of class on Zoom, and someone asked, when is assignment 2 going to be released? I didn't answer because I'm going to answer now. Assignment 2 is going to be like assignment 1. Just different. In assignment 1, you had to look at Bank of Canada rates and do some yield bootstrapping and this and that, right? You're going to do almost the same for assignment 2. But of course, I'm not going to give you the same assignment. You're not going to learn anything. So assignment 2 is beginning now. I will give you enough information so that you see what assignment 2 is going to be, but I won't be able to tell you everything you need to know until next week for the technical part. But assignment number 2 is not going to have only a technical part. That would be unfair, because I told you this course is there to be useful for you. So it's going to have also a presentation component to it, for which you need to listen to the last class here. So on April 8th, I will be spending 3 hours on communication skills, human skills, presentation skills, stuff like that. Only then you'll understand how you have to do assignment number 2. So you're going to be able to do all the work, but you're not going to be able to submit until after April 8th, the last day of classes. All the work will have to be done prior to that. But the actual presentation will have to be done, the actual submission will have to be done after April 8th. You're going to have all sorts of numbers and who knows what. But then I'm advising you that your submission has to be 1 page. 1 page. So you're going to have to spend some hours after April 8th figuring out how all the work you would have done in the next month, roughly, will fit in one page. All right? I'll tell you that as today and especially as next week comes along. And it all comes from here because now we just made connection between credit now and the first day of classes and how to value cash flows. And this is going to be very, very useful for us. It's going to give us a very powerful way of looking at credit. We're going to see that. In a certain sense, what's going to happen is that each counterparty carries its own yield with them. And then a lot of the finance that you want to do with a counterparty, you can do by taking the yield of that counterparty. If you knew that, for example, pricing the good rich deal would be very easy. You're going to have some payment, you know what the yield is, it's like valuing a bond. And then you can get the good rich deal. You can find X and Y and you can make the deal happen. That would be very easy. We could do that, right? We will be able to do that with some qualifications, which is what I will spend time with next week. All right? So just the introduction of this hazard rate is going to make things remarkably not easy for us, but it's going to make a connection between this section on credit and everything else we've learned. This is the connection. Now, the thing is, to know the hazard, I need to know the probability of solvency. No one said that's easy. In fact, it's not easy. In fact, I already told you there's no history to work with. So we're going to have to do some more work. Okay, this is just the connecting point, but it's not going to be the solution of our problems yet. It's just the connection. Now, that number H that we have there, although it is related, or it comes from the hazard rate, because the hazard rate is a very general term in probability, for us it's going to have a different name. It's going to be called a credit spread. Why? Because it's going to tell me how much bigger my credit interest will be than yours or the Bank of Canada or the Fed. Credit spread. It's going to be high for low rated counterparties, and it's going to be low or even zero for less risky counterparties. Okay? So that is going to be the basic building block for credit, that number, the hazard rate or the credit spread. Now, I have here an example. It's actually a problem in one exam. I think it's the PRM. And the problem is as follows. This is just to show you how we've already advanced something. We already climbed the hill without knowing, okay? Just because of everything we've learned in the first half of this course. So this is an actual exam. This is an actual exam question. It says, a senior unsecured double B rated bond. Do you know what that means? Doesn't matter. You will see. It's a bond. You know what a bond is, right? I'll come to that. Matures in exactly 5 years and is having an annual coupon of 6%. I have a table down there, okay? The question says, using the table for a 1 year zero curve for each credit rating that I have here, you need to calculate the 1 year forward value of that bond. We can already answer this question. Let me read it again. Actually, no, you read it again. I'll read it with you. Okay? Have a senior unsecured double B rated bond. What does that mean? Senior means what? Means that it's the first bond to be paid in the case of bankruptcy. It's just something that we will see in detail next week. We can ignore it today. Unsecured means that if there's default, there's no recovery. It's coming up a little bit later this morning, okay? We can ignore it. Matures in 5 years. And they're asking for the 1 year forward rate. Well, the 1 year forward rate is going to be something that I need the 4 year forward rate to calculate with, which is what they're giving me here. So this is it's going to be a very, very simple problem to solve because I have to find the 1-year forward rate. How am I going to do that? I'm going to do that by discounting cash flows, which I already know how to do. Most of what's here is from the first half of this course. It's just that the notation and the nomenclature is different. But we just need to discount cash flows, and they're giving me the discount curve right here. That's all. So I didn't need anything to do this from this course except the connection between credit and the credit spread. Because then how I do this is very simple. The solution is going to be, this is the question, the solution is I just discount cash flows. Of course, here we discount with annual compounding because that's how this problem is done. I mean, only mathematicians do instantaneous compounding, but otherwise the calculation will be exactly the same. So I have my 1-year cash flow forward. I don't have to discount because it's the 1-year forward is the same, 6. And that's a mistake. That's 106. I apologize. 106. The last payment is 106. Okay? So, and this is the rate, as you can see, is the rate from, it matches there and there. 102. And whatever. Okay? And if instead of double B, you change that by A or double A or whatever it is, which I haven't told you what it is, but it doesn't matter. You don't need to know. You just replace that by the correct rates. Right? Yeah? Again, that is 106, that last term. Okay? Made a mistake. I got too excited with the copy paste. Yes?
What happened when the bond rates like change every year from like the 2B to 3B to A? Or
So you're asking me what will happen to the future value of this bond?
yes.
It will change, but that's not the question.
Oh.
The question is very simple. The question is what is the value today of the 1-year forward of that bond? You just discount cash flows like I'm doing here. Yes?
So based on the calculation, shouldn't the numbers be spot rates instead of forward rates?
Oops. No, because I'm asked. I have to do the value of the. Let me just go back to the question. Okay. Just go back. So I have to go back to the previous one. Let me just go back here. It's faster. Okay. We're getting there, we're getting there. There we go. So this is the forward curve, right? The forward curve is what gives me the value of the 1-year, 2-year, 3-year, or 4-year rates next year, right? And that's what they're asking me. They're asking me for the value of my bond a year from now. So I'm going to use the spot rate a year from now. That's what the forward is, right? They're not asking for the present value. Then I would have to use something different. They're asking for the forward value. There you go. Okay. Asking for the 1-year forward price. That's why. That's why I have to use the forward rate. Yeah? And since you mentioned that, there's a condition here which I neglected to say, if the obligor stays double B. We're going to see this very often, okay? Because if it changes from double B to triple B or A, then of course it's going to change, assuming that it stays the same. Okay? Okay, good. So that's that. So we can already begin to solve problems. This formula we just saw is very powerful. It helps us get started and do a lot of stuff. And it's so powerful that it's going to allow me to introduce my very first credit model. It's very basic, but it's extremely powerful, especially intuitively. I want to use this to develop an intuition for credit calculations, not for credit as a concept. I'm going to assume my counterparty can be in one of two possible credit states only, solvency and default. Of course, that's always the case. You can be solvent, you can be on default. But I'm going to add something else to it, which is that the probability of staying solvent, conditional you're solvent at the beginning of a period, a year, does not change. Okay? So I'm assuming that your credit quality does not get better or worse, it's constant. That's why this is a very big assumption. In other words, I'm saying that the probability that solvent at some point, conditional that I was solvent a year before, is constant. It does not change. It's always the same. You can get better, you can get worse. So if assume that, let me ask you a question. What would the probability of solvency be at time t sub I? It's skewed to the power t sub I. If you don't see that, let me ask you a question. I'm sure you see that. What's the probability I get heads if I flip a coin?
50%.
50%. What's the probability I get heads again, two heads, conditional I get heads the first time I flip it? The same, it's 50%. What's the probability that I get heads 2 times in a row? 25%, right? And it'll be 50% to the power whatever. So because of that, at time t sub I, the probability that I'm solvent is skewed to the power t sub I, if the probability is the same. Right? Great. So if that's the case, then my hazard rate is the logarithm of Q, is constant. My hazard rate is constant. My credit spread is constant. So I'm going to rewrite that by saying the following. It's exactly the same thing. I'm not going to change anything. I'm just going to use a little bit of a mathematical language for that. It says that if my credit follows a Markov chain with 2 states, and the transition probability matrix is given by this, then my hazard rate is constant. And I know that the probability of solvency at any point in time is that number Q raised to the time at which I'm calculating my solvency. Yes? It's a very simple credit model, but it has a very interesting implication. In fact, we're going to extract full value out of this, because the fact that the probability of solvency gives me the credit spread means what? Means that if I know the credit spread, I know the probability of solvency. Right? And what do you know most often? In this expression, what information is given to you by the market? H or Q? No one tells you Q. The market tells you H. Right? We're going to see that. So that means that in practice, we're going to use this to calculate Q. That's why Q will be risk neutral, because it comes from a spread of some bond somewhere. It's remarkable how everything starts to fall into place, don't you think? Okay, there's more. There's more. Now, the implication of that is that if I have here a graph that includes a possible, I call it the risk-free rate, say the Fed, or we don't have LIBOR anymore, so I use the Fed as the risk-free. And then I have a possible curve for the double B rated bond, right? They could be like that. And what I can see is that the spread there and the spread here are different. What does that mean? That means that my model is inconsistent with this market observation. Okay? You see that? If this is real, if this is what I observe in the market, then my model cannot predict this. No, my model is inconsistent with this because my model will predict that the spread is the same, it's constant over time. That's what I'm saying. Understand that? Do you understand that? It's a very simple model. Don't worry, we're going to make it better. But we need to understand the simple model because with the simple model, there is so much we can do. There is so much we can do. And then we'll make it better. Then we will be able to deal with situations like this. By the way, I'm going to link this to your assignment number 1, which will become assignment number 2. I asked you to calculate the blue curve on your assignment number 1, and you did that for 2 weeks, right? It was not the Fed curve, it was the Bank of Canada curve. Big deal, right? You calculated a risk-free curve. Did you notice there were bonds for Bell Canada, Bank of Nova Scotia, Province of Ontario, TransAlta? Did you see that there were other curves for other companies when you were getting your bonds? Did you see that? Did you see that there were bonds issued by other companies? Did you see that? You ignore them, right? Yes, because I asked you to ignore them. But imagine I ask you now, no, go back there and get me all the green lines too. Could you do it? Could you do it? What would change? How did you do your assignment number 1? You use Python, Excel, you did it by hand. How did you do it? Python, right? Will your Python code work on the Bell Canada bond curve?
Maybe.
Maybe not. Why not? The Bell Canada bond has coupon payments,
Yes.
maturity date,
Yes.
a clean price,
Yes. And dirty price.
and well, no, the dirty price that's in your code. It's not in the market, right? It was not an input, right? So what would break in your Python code if you apply it to Bell Canada yield curve?
Technically, nothing should break it.
Nothing will break it. I'm telling you, nothing will break it. Your Python code will work too. What did you use? Python. Will your Python code work for Bell Canada? Yeah, it will work. What did you use? Python. Will it work for the Loblaws bond curve? They have bonds too. Yeah, it will work. Did you do assignment number 1? Yes. What did you use? Python. Okay, will it work for, I don't know, British Columbia provincial bonds? Yes. It will work, right? So actually assignment number 1 was wonderful because it works for the green curve too. And if you do it, how likely it is that you're getting something whose spread is constant, exactly a constant displacement from the bonds you already calculated? It's very unlikely. So my model is very inaccurate for now, but it is going to be wonderful. You will see. It's going to be a wonderful model that I don't want you to forget because it is simple, but it's not too simple. It's going to be simple enough. But you could do that. You could do that. You could do the blue and the green. And then you will be able to see how inaccurate our model is. All right? Are you with me? You could all do this, whatever you did. Even if you did it by hand, do the same thing you did by hand for the bonds of TD Financial, and you'll get the TD curve. It's the same. That's the wonderful thing that we just saw earlier, right? Because as with market, once I have the curve, I can do so much with the curve. It's the credit curve now. Okay, I hope I convinced you of that. Let me continue, because I want to have an application to sovereign risk of this simple model we just invented. It's very simple, it's inaccurate, but you will see how powerful it is. I'm going to, you may not remember this, but there was a case in history, 2012 was the year, when there was this very big discussion in Europe whether there was going to be a Grexit. You remember Grexit? Were you old enough to remember Grexit? You know Brexit. No one was talking about Brexit with a B in 2012. Everyone was talking about Grexit. You know what Grexit was? That was Greece leaving the European Union. You don't remember that? 2012, where were you? You were old enough. No? Too young.
Like Greece going bankrupt?
Yes, exactly, yeah. The whole point was Greece going bankrupt. And some people, in fact, some people in Greece, I was in Greece that year, some people in Greece say, we'll just leave the European Union, back to the drachma, and then screw Europe. Okay, that was the conversation in 2012. In fact, there was a referendum in 2015 for that. And the answer was to stay in the European Union. So Grexit never happened. The year after, 2016, Brexit happened. Everybody was surprised. And then actually Britain left. But that's a different story. I'm not interested in that. I'm interested in this. Okay? So, and back then, in the news, they were quoting the spread almost daily. And every time there was a new maximum for the spread, it was in the news. Why? Why? We know why now. Why? Why is the spread in the news? Because the higher the spread, the more likely they are to go bankrupt. And if they go bankrupt, they may leave the European Union. And that will have tremendous consequences, right? So let me calculate the probability they go bankrupt. We can do that. We can calculate the probability that Greece goes bankrupt based on market information with my very simple homemade model. And I don't need Python for that. I'm going to assume a certain notional. I'm going to assume a certain probability of solvency, which is risk neutral, which is constant for 1 year, call it Q. That's my simple model, homemade. And I'm going to make this model actually a little bit more realistic by introducing another term that is going to be one of our friends next week. It's called the recovery rate. Remember when I told you in the exercise earlier there was an unsecured bond? I said, what does unsecured mean? Unsecured means that if there is default, you get nothing. Typically, bonds are secured, meaning that, what does that mean? That means that if you default, your creditors have access to all of your assets wherever they are. Right? Goodrich, I take all your tires, whatever they're worth, I take them as partial payment for what you owe me. Right? Okay. So when there is a default, typically there's a recovery rate. The recovery could be 0 if you get nothing back. Case of, for example, many telecom companies who just some used phones, that's all they had, who can resell CPUs, right? No assets. Sometimes you have recoveries you have bankruptcies with a lot of recovery rates, with very high recovery rates. So what you recover is a number, we're going to call it R for this example. In fact, we're going to assume it is 50% for the purpose of the way we think, but we're going to do our calculation properly with R as a random as a variable. You understand this recovery rate? Okay. When they say default, what was the last default that you remember?
Of a country or of a company?
Sorry?
Of a country or of
I don't care.
Silicon Valley?
Silicon Valley. Okay, Silicon Valley Bank went bankrupt. How much money did the creditors get? I'm guessing 10 cents in a dollar, maybe. Okay, they didn't have nothing, right? They had money, they had bonds that went down in price a lot, but they had some bonds there. So all the bonds, they go to whom? First, they go to pay taxes. That's number one. The government is first at collecting whatever is theirs, right? Next is the lawyers and the judges and the liquidators, the legal people. They get all of whatever is left goes to whoever owed them money. Okay, so whoever they owed money to, that goes to them. Right? There's some number there. We call it R. We don't know what it is. R. Yes? Okay, so if that's the case, then let me do the following calculation. I'm going to write down my cash flow valuation formula, taking into account a country and possible recovery. So that is the cash flow valuation formula. No coupon payments, I'm going to make it easy. I have a notional, I have the probability of default, I have my interest rate, riskless interest rate, okay? Then that is the no default event. That's the value of my payment if there is no default. That is my payment if there is default but I get recovery, is right there. And Q is risk neutral, so it's good. And now I'm going to use the spread, which is given by that. And you see that's where that's the riskless interest rate. In the case of Greece, that was considered to be the German rate. The advantage of Europe is you have different countries with the same currency and different probabilities of default and different yields. It's the only area where you have that. Normally, if you want to do this calculation, you have to take into account cross-currency considerations. I don't have to do that. That's why Europe is such a good example for this thing I'm doing here. You can do this for other countries, but then you have to add another layer of cross-currency considerations, which I don't have to for Europe. Okay? So that is the value of my spread. The spread is the value of the asset of my bond, is the notional discounted with the credit spread. Yes? We've seen all of that. Are you with me? Well, then you know what's next, right? I got V there, I got V there. These things have to be the same. I know every other variable except what? Except Q. So we solve for Q. That's it. This is algebra. This is high school math. That equals that, and then that's my Q. And by the way, I can get the probability of default to be exactly that. So observing the credit spread of a country, I can tell you how likely that country is to go default. My very simple model, sure, will make it better, don't worry. But with my very simple homemade model, without Python, I can tell you the probability of default of a country.
Sorry, this probably default exactly 1 year later, like in a year.
The probability of default in a year, everything's in a year. I'm taking 1 year, so the interest rate is per year, the probability of default is per year. I'm taking a year as my unit of time.
And H is a spread exactly 1 year later? Or?
Sorry, what?
H is a spread.
H, no. H is the spread that I observe. It's in the market. I'm going to show you. I have the numbers. I have the numbers. And the recovery rate, I'm going to say 50% to calculate things because I don't really know, but let's say with 50, we just go to the next numbers. I have here, for example, okay, 2012. 2012 was about the worst year for the spreads, right? See, Greece is not even here. In 2012, they were talking about other countries like France or Spain going bankrupt. Greece is a very small percentage of the European Union GDP, like 5%. But France is like 25% or something. It's big, right? Look at France. France had a credit spread of 135 basis points, which if you follow my formula, our formula, homemade, no Python, shows me a probability of default of 2.7%. It's not far from the truth. It's a very simple model. We're going to make it better, but I want you to appreciate this simple model. I want you to appreciate this simple model, okay? Because intuitively it's going to be very, very strong. Calculationally, no, we'll make it better. Don't worry, we'll make it better. But this is so simple. Portugal, 900 basis points. Probability of default, 17%. That's big. Spain, 400 basis points, rate of default 8%. Spain is a big percentage of the European GDP. I don't know, 15%? I have no idea. These are big numbers, but we can do these numbers ourselves. You can do these numbers. What do you need to do these numbers? Assignment number 1. Assignment number 1 is really useful. You can calculate what's the probability of Bell Canada going bankrupt. You can say 0. Well, 0.00 something, but you can calculate it. Take your Python code, take the dust off it, apply the Bell Canada bond, and you get a number. Take the difference. That's the probability of default. Yeah? Okay, I continue. This is wonderful. And there was no, are you tired? The client was not hard, right? It was, yeah? Very simple. We can do a lot with this. This is, I want you to realize how wonderful this is. It's not a coincidence, because that's why we work so hard for the first 2 months of this course, right? It's beginning to pay off. We can do these things now very easily, and we'll do even more. Yeah? Are you with? Yeah? You understand this? Okay, all right. So let me make this a bit more realistic. What was wrong with my assumption? I said I have two credit states, right? Default, no default. You say, well, that's always the case. Yeah, but it's not very useful. I mean, we're all here solvent, I assume, right? But our model is not going to be very useful to understand that. So what we're going to do is we're going to introduce, is the same Markov chain, but instead of 2 states, more states. How many? Pick a number. What number do you like? I like 8. You're good with 8? It's better than 2. 8 is pretty good. The actual number that is used in practice is more like 20. But we're going to see them today. No problem. No problem. Because what I'm going to do now is I'm going to put everybody into risk buckets. I'm going to put everybody into credit quality buckets. You get yours. How? As Loblaws and their loyalty program. They will tell me that's what Scotiabank did in Chile, right? That's a different question. I'm assuming I have the data now. Let me proceed with the Markov transition probability matrix. That's all I want to use for now. My transition probability matrix in the case of 2 states was very easy because it was parameterized by a single number. If I have 8 credit states, how many degrees of freedom do I have in my credit, in my Markov chain? 8. With 8 credit states, how many degrees of freedom do I have? Let's see. The last one is very easy because the last one is default. There's no recovery. So that one is 1, 0, 0, 0. I know that. So there's 7 rows and 8 columns. But I know that each of the rows add up to 1 because they are probabilities. So I have 49 degrees of freedom if I have an 8 state Markov chain. Yeah, 49. So I could calibrate it with how many pieces of data? 49. Right? Yeah.
Like we mentioned, like the PIJ is an additional probability of changing from state I to state J.
Yes.
I want to know, like, when will we accept this additional probability and when will we not? Like, when will we actually change the state I to state J, and when will we like deny the probability and don't change the state?
I don't understand what you're saying.
Like, we know there's a probability that we may change from state I to state J.
Yeah.
But like, when will we actually change from state I to state J? Basically.
From one credit state to another.
Yeah.
From credit state AA to BB, for example. That's what I mean. Okay?
Yeah.
And by the way, needless to say, that probability better be risk neutral. So it should be the risk neutral probability of changing from AA to BB or something like that. And by the way, risk neutral is good because it's the only one we will be able to calculate. Who knows what Apple's credit rating will be next year? I have no idea. I suspect it's going to be AAA, but I don't know. Right? The market will tell me it's AAA. It's very high probability, but I really don't know. It's got to be risk neutral, right? So who does that? Who does produce these things? And now we get into the first touch of the commercial aspect of this, which I will do fully next week. But the first touch is credit rating agencies do this. What do they do? What do credit rating agencies do? What do they do? You know what they do? Have you heard of them? Some names here: Moody's, S&P's, Fitch, Dutton Phelps, Dominion, bond rating systems, DBRS. What do they do? What do they do? Have you never heard of them? Never? They rate companies, they rate countries, they rate bond issues. Okay? So you go and check, and Canada has, I think, a AA rating by S&P. Why? They say, well, I look at something and this is my number. But they don't only give you numbers, they give you matrices too. They give you the whole Markov chain. That's what they do. We're going to see that. Okay? Now let me ask you a question. Who pays these companies? How do they make money? I told you, no one works for free anymore. People work for free before reading week. After reading week, everybody gets paid. Who pays them? The companies who are rated pay them, yes. Isn't that a conflict of interest? Isn't that a conflict of interest? You pay the company that's going to give you a rating? Really? Is it a, what do you think? Yes or no? Who thinks it's a conflict of interest? Raise your hand. Raise your hand. You have to vote, okay? I don't accept abstentions. I don't accept. So raise your hand if you think that's a conflict of interest. If you think, not if you know. If you think, you don't think it's a conflict. Raise your hand if you think it's not a conflict of interest. Some people didn't raise their hands. You have to. Okay, I'll start over again, okay? Raise your hand if you think it's a conflict of interest.
Can you repeat the question louder?
Yes. Rating agencies rate the issuers. So you have a bond issue, you go there and say, S&P, please rate my bond. Say, okay, I'll rate your bond. And you pay them for that. Is that a conflict of interest? Raise your hand if you think it's a conflict of interest. Now raise your hand if you don't think it's a conflict of interest. Okay, I can see people are, okay, fine. Let me ask you a question. Who gives you your degree?
University.
Exactly. Who pays the University of Toronto to give you your degree? Is that a conflict of interest? Raise your hand if you think it's a conflict of interest. Raise your hand if you don't think it's a conflict of interest. Okay. This is an interesting point that I try to stay within, mathematical finance when I teach this course. But I like you to develop that business sense. I mean, I assume most of you come from science backgrounds, and I still want you to have that business sense because it's very useful when you go into the financial industry. And I assume many of you will end up there. You need to sometimes think like this also. Okay, you need to think like that also. If it was a conflict of interest, what would U of T do if we really, acted on as a conflict of interest? What would we do?
There has to be some sort of third party or something.
Well, there could be a third party, but the thing is that we don't need a third party. Why? Because the University of Toronto has this thing which is called our own ranking, done by someone else, right? So in a certain sense, you can say that it's a complete market. We rate you, someone else rates us. You know what? No, I'm not going to risk my rating with someone just because of your mark. So yes, you're suspended. Get out of here, right? In a certain sense, credit rating agencies, they have the same pressure. Their business depends on that. If people start to doubt their ratings, then they will lose that. And that was the issue in 2008, because many AAA rated bond issues, they went bankrupt overnight, right? And that was a very big risk for the rating agencies. And then, well, they work very hard to maintain their reputation, just like U of T would work very hard to maintain our reputation if we give a degree to one of you that we're very embarrassed about, right? And by the way, you should not do that. Never embarrass U of T. That is not allowed, okay? That is not allowed. Okay. All right, so there's an interesting discussion here, but I'm going to leave it for a better time. I want to show you here how the S&P rating system works. There are basically two types of ratings, those which are called investment grade, better than double B, and those which are non-investment grade, which are lower than a double B. If you want to know the difference between those, you can think, for example, a pension plan, a reputable pension plan would typically, if they buy bonds, they would typically buy bonds up there. The bonds which are here, they became very popular in the 90s, and they're called junk bonds, okay? But sometimes they're worth it. In fact, we will see in a few weeks, we will see how we can trade these non-investment grade bonds and do very well with proper hedging, okay? And then we're going to use everything from credit for market, and it'll be a feast to actually create a trading strategy where we eliminate risk altogether, So this is not, don't let the word junk bond tell you that there's something really junk there. There was just the name that they developed in the 90s for things unrelated to finance, really, okay? A few people went to jail because of that too. That didn't help, but we're not concerned with that. The fact that these are non-investment grade, that means that if you get here, you have to get there very carefully, okay? But the thing is that you are very smart people, you know a lot of machine learning and who knows what. You may be working in areas, in companies that actually that's what they do, okay? You may be working in areas that's what they do. They invest in these types of bonds, and they have a way of eliminating a lot of the risk in those bonds. We will see how we can do that, okay? All right. Now I have here for you, for your inspection and your admiration and pleasure, the S&P Transition Probability Matrix of a certain year. And like I told you, credit rating agencies, what they do, not only give you the rating, they actually give you the whole matrix, okay? Now, it may seem that this matrix is not very interesting, but let me ask you a question. Look at that number. What does that number mean? That's the probability that a triple C rated company becomes triple A next year. Yeah? Is it weird that that number is bigger than that or that or that? Is it weird? Is it weird? Depends. If you're a mathematician, no, I don't care. No, it's a Markov chain. There's no relationship between these numbers. No, there's nothing weird with that. Why are you asking? Right? But then you may look at this matrix with a certain amount of intuition and say, I find that number to be counterintuitive. No one said this matrix has to be intuitive. It's a matrix. But if you appeal to your intuition, what could explain that this number is bigger than that?
They could be doing like riskier things. They could be doing riskier things and have a bigger payoff as a result.
Well, I mean, I really don't know, but my hypothesis would be, look, every startup starts with a triple C, right? And then guess what? You do very well. So the chances that you are going to do very well is they're somehow better for you if you're a startup than you're already an established company, that you have your chances. Maybe, again, I don't know, but intuition is not what drives this matrix. But it's good to understand what this matrix is made of. Clearly, this matrix is only monotone on the D column. That's what we use to rate counterparties, right? So for sure there, we do expect monotonicity. Everywhere else, no, we don't. There's no monotonicity expected from a Markov transition probability matrix, right? By the way, anybody here has never seen a Markov chain before? Raise your hand, don't be ashamed. I just assume not, but because I'm explaining that now, I'll do it more carefully. You've seen it, right? Yes? Oh, okay, good. All right, so then in that case, then let me end today by talking about long-term transition probabilities, because this is very powerful. This thing we developed here is very powerful, okay? Imagine I have a transition probability matrix. It's given to me by S&P, right? Okay, great. What would the transition probability matrix be for 2 periods, not 1, 2 years? I don't know. Let's calculate it. The probability that I go from I to j in 2 years is the probability, conditional, I mean I, and I go to all intermediate k's, and then from k go to j the year after. And that's that probability, right? Yes? But you would recognize that this is the elements of the product of the matrix A with itself, right? Because then what would be the transition probability for a period of, say, 30 years? Or n number of periods, what would that be? It's a to the power, and you've seen that in Markov chains, yes? Yeah? And you probably have seen that I can do this also for any fractional. Like, for example, what is the transition probability matrix for next quarter? Is a to the power 1/4, right? Yes? Okay, and do you all know how to do a to the power 1/4? I mean, this question has really two, sorry.
I was going to say, to do something like that, do you need your matrix to be symmetric or something?
No.
No?
No, I'll tell you what you need. But first, let me ask you, do you know how to take the square root of a matrix, or a to the power 1/4?
You diagonalize it.
Yeah, you can do that, but that's a lot of work. It's easier. And actually, to diagonalize, you need the matrix to be diagonalizable, and these matrices are typically not symmetric, so we need a different. A series expansion, that's right. A series expansion will work. I have it here, actually. That's the formula for it. For that, the only thing you need is you need the matrix to have a spectral radius which is not bigger than 1, right? And Markov matrices have that. The fact that the sum of all the rows is 1 means that 1 is an eigenvalue, and all the other eigenvalues are less than 1. So that means this series will converge. So you can do it that way.
But there are like convergence issues with this, right? Like,
No.
You're not going to get exactly a to the 1/4. You're going to get something close.
Yeah, sure, of course. I mean, but this formula that I have here is exact.
Yeah, sure, but you can't take an infinite sum.
Look, you don't know the square root of 2 either, right?
Right.
Yeah, and we work with the square root of 2 all the time. So that is how you would do it. Of course, you can get Python code that'll do it for you, or code in any language. You can do it in Fortran. You can do it in C++, right? These things are done. And perhaps the thing to mention here is that, of course, when I'm writing this thing here, everything here is computationable, right? This number is computationable, and these numbers are because this is polynomials of your matrix A. Polynomials you can do with calculations, with computer-based calculations, right? So it looks like we can do a lot of things with credit. What do we need? What do we need? We need data. How much data? Actually, not a lot. If you think about everything we did today up until here, if you think about that, what do I need? For my sovereign country risk calculation, I needed a spread. It was a very simple model, but I can make that model better with a bigger Markov chain. And then what do I need? I need two things. I need the transition probability matrix, and I need someone to tell me the counterparty is in what state. That's it. Credit rating agencies do that for me. I can buy that. But let's say I don't want to buy anything from anybody. Or let's say that I'm Scotiabank doing my Chilean deal and no one is rating me. The Metro supermarket does not rate their customers. They just give me data. How would I do it? I would need to do what? What do I need to do? I'm trying to make connections with courses you've taken outside of this one. Sorry?
We're finding the long-term distribution.
Long-term. No, I don't need long-term. I need one term. I need 1 year. I need a transition probability matrix, right? Which contains, how many did we say? 49 variables, right? So I need data, a few gigabytes, to calibrate a model with 49 variables, right? Yeah? And how hard is that? I have how many customers? How many customers does Loblaws have? Registered customers. Give me a number. We don't know, but neither do you. Give me a number. How many?
1 million.
1 million. Good number. I love that number. 1 million. They have 1 million customers, right? So I need to calibrate a matrix of 49 variables with 1 million customers. Can you do it? If I made this to be your assignment number 2, could you do it? If I give you the data, yeah, you could do it.
You feel like, I mean, I guess
You could do it.
one of these things about machine learning, but you feel like you've overfit that.
No. Well, of course you're going to overfit. Well, it depends what overfitting means. How would you do that? You have, first of all, what you need to do is you need to have customer information, and you need to clusterize the customers. Because you have 8. You have to put them into 8 buckets, right? The big liars, the fat liars, the no liars, the people who tell the truth. You pick it. It's up to you. In fact, you don't have to label them. The computer will label them for you, right? You've done that probably, yes? Okay, so you can do your buckets, and then you can do your transitions, because it's just you have data over time. You say, oh, but this person changed from here to, and then you can get probabilities, right? You can calibrate that. So you can do it. Imagine I do this for bonds. How many corporate bonds do you think are in the same database you did your assignment 1? How many? 100? Different corporations? Let's say 100, yeah? 100 corporations, you need 49 variables. Can you do it? Probably. Is it going to be very good? We don't care about being very good right now. We just want to know, could you do it? So yes, you could, and you will calibrate it, right? And then when you do that, then you have what? You have your whole credit risk system. You could become S&P 500 or Moody's rating system. You could be that yourself, no? You feel powerful that you could become the next Moody's? You can become maybe better than Moody's if I give you really good data? This suddenly looks like not very hard, right? Why? Because everything we've learned. Everything we've learned. So for your assignment number 2, and I will end with this, for assignment number 2, what you will have to do, I can tell you now, is you're going to pick one company or province or anything with bonds in that database. Okay? Anything with bonds. And you have to do the credit profiling of that company. That's your assignment number 2. Say Bell Canada. Okay? Not a very interesting company to do this credit profiling, but who cares? Take Bell Canada. They have a few bonds. You're going to get the Bell Canada curve. Yeah? You did it in assignment number 1. You're going to have to redo the Government of Canada curve because that's going to be your risk-less curve, right? Yeah? And then you're going to do the spread. And now I give you a lot of freedom how to do this. A lot of freedom. You can say, I'm going to use a one-factor model like the one we did here. I'm fine with that, right? You don't have a lot of data, so maybe that's the one you have to use. Then you use the one-factor model, and then you can get the probability of default and some other things which I'll ask you to do. I'll write this down for you, but only next week, because you're going to have to use other models that we haven't seen yet, because I want you to compare. This thing we've seen, you could already start doing it now, but don't do it now. My recommendation is, given what you've learned, start thinking of a company you would like to do this on, and then next week, where we will see more of this, then you will have, okay, I need to do something. And then I give you a mock-up of what you should do. Taking into account that it's going to be 1 page. 1 page. And you say, I have to use very fine print to put all of this into 1 page. No, wait until you see my communication lecture, and then you will see that, no. You want big fonts, not small fonts. Understand? That's what your assignment number 2 is going to be. You haven't seen all the technical stuff. You've seen the beginning of it. The technical stuff is something that you will do. Will not take you a long time because most of the work was already done. I hope you did not delete your Python code. Did you? No? Oh, okay. Good. Frankly, I don't even care if you use the Python code for that anymore, because the assignment is not to get me that. You can just download it from Bloomberg. I don't care. Okay? But there will be some things that you will need to do, and I will show you next week. That's what your assignment number 2 will be. Questions? No? No. Then we're done. I will continue next week. Next week, also in person. I expect to have all of my remaining classes in person. I do have more trouble, but I think every Monday I will be here. So,
Thank you.
very good. Thank you.